Welcome to Part C of our six-part series on balance of payments and exchange rate regimes. In Parts A and B, we built up the balance of payments framework. Now we shift gears to the exchange rate, the price of one currency in terms of another. We will see how exchange rates are determined in markets. We will distinguish between fixed and floating exchange rate regimes. We will examine the role of central bank intervention. We will look at the costs and benefits of each approach. By the end of this video, you will understand the fundamental architecture of the global currency system. Let us begin. Section 1. What is an exchange rate? An exchange rate is the price of one currency in terms of another. When you read that the shekel-dollar rate is 3.7, it means $1 costs 3.7 shekels. Or equivalently, 1 shekel costs about 27 cents. This single number, the exchange rate, is one of the most important prices in any economy. It determines the cost of imports. It determines the value of exports. It affects every cross-border financial flow. Small changes can have enormous consequences. A 10% appreciation of the shekel can devastate exporters. A 10% depreciation can spark inflation through more expensive imports. Section 2. How exchange rates are determined. In free markets, exchange rates are determined by supply and demand. The demand for shekels comes from foreigners who want to buy Israeli goods, invest in Israeli assets, or take vacations in Israel. The supply of shekels comes from Israelis who want to buy foreign goods, invest abroad, or travel internationally. When demand exceeds supply at the current rate, the shekel appreciates. When supply exceeds demand, it depreciates. This sounds simple, but the dynamics are enormous. Trillions of dollars trade hands in foreign exchange markets every day. The world's foreign exchange market is the largest financial market in existence. Section 3. The supply and demand diagram. Let us picture this. On the horizontal axis, we put the quantity of dollars traded. On the vertical axis, we put the price, the shekel-dollar rate. The demand curve for dollars slopes downward. When dollars are cheap, Israelis want more of them. The supply curve of dollars slopes upward. When dollars are expensive, foreigners want to sell more of them to get shekels. The intersection determines the market equilibrium exchange rate. This is the basic economic logic underlying all exchange rate analysis. Section 4. Fixed exchange rates. Some countries do not let their exchange rates float freely. They peg their currency to another currency at a specific rate. To maintain the peg, the central bank must stand ready to buy or sell foreign currency on demand. If market pressure would push the rate down, the central bank buys its own currency. If pressure would push it up, the central bank sells. Hong Kong has had its dollar pegged to the US dollar at 7.8 since 1983. Saudi Arabia pegs its rial to the dollar. Denmark pegs its krone to the euro within a narrow band. Fixed exchange rates provide certainty and stability, but at the cost of monetary policy independence. Section 5. Floating exchange rates. Other countries let their exchange rate float freely. The market determines the rate. The central bank focuses on inflation targeting or other domestic goals. The United States, Eurozone, Japan, the United Kingdom, Canada, and most major economies operate floating regimes. The advantage is that the central bank has full freedom to set interest rates based on domestic needs. The disadvantage is that the exchange rate can swing wildly, creating uncertainty for international trade and investment. Most modern major economies have judged the trade-off worth it. Section 6. Managed floats and intermediate regimes. Between pure floating and pure fixing lies a vast spectrum of intermediate arrangements. The most common is the managed float, sometimes called a dirty float. The currency floats freely in normal times, but the central bank intervenes selectively during periods of excessive volatility or unwanted trends. China has operated this way for decades. India also. Israel's Bank of Israel has intervened heavily since 2008. Some countries use crawling pegs, letting the rate slide along a predetermined path. Others use band systems, letting the rate float within explicit limits. Each regime represents a different balance between predictability and flexibility. Section 7. The Trilemma. International macroeconomics has a fundamental constraint called the Trilemma, or Impossible Trinity. A country cannot simultaneously have three things: a fixed exchange rate, open capital flows, and an independent monetary policy. It can have any two, but not all three. The United States has open capital, an independent monetary policy, and a floating exchange rate. Hong Kong has open capital and a fixed exchange rate, and its monetary policy is set by the U.S. Federal Reserve. China historically had a fixed rate and independent monetary policy, but maintained capital controls. Every country has to choose which two of the three it wants. Section 8. Why this matters. Exchange rate regime choice is one of the most consequential macroeconomic decisions a country can make. Fixed regimes provide certainty but constrain policy. Floating regimes free policy but introduce volatility. Intermediate regimes try to balance both. The choice affects inflation, growth, employment, trade, and investment. It determines what tools the central bank can use during crises. And history is full of examples of countries that chose poorly, pegging their currency at unsustainable rates, suffering speculative attacks, then crashing into devaluation. Argentina, Mexico, Thailand, and many others learned this the hard way. Understanding the regime architecture is essential for any serious analysis of international macroeconomics. Conclusion. We have built the foundations of exchange rate analysis. We have seen how exchange rates are determined by supply and demand. We have distinguished fixed from floating regimes. We have surveyed intermediate arrangements. We have introduced the trilemma. In Part D, we go deeper, examining the mechanics of central bank intervention, the dynamics of speculative attacks, and the economics of currency crises. If you found this introduction useful, please share the video and subscribe to Macroeconomics with Michael for the rest of the series.